Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted today to be able to introduce the Stocks for Follow discussion with capital markets expert John Human. So welcome, John.
Hi, Paul. How you doing?
Yeah, not bad. Well, the markets have had quite a good rally, actually, over the past 2 or 3 weeks, which is largely on the back of sort of like declining inflation expectations and lower bond yields. But is this another one of those head fakes, another bear market rally, or is it more sustainable? What's your view?
I think it's a bear market rally. Of course I do. It's my nature, but and it has, there has been some softening in the last few days. Particularly over in the US, and I think the tensions, as you say, have shifted. Well, there has been this view that inflation is starting to moderate, and evidence that inflation is starting to moderate. But I don't think it's gone away entirely, and I don't think we've seen the last of the interest rate rises around the world, particularly in Europe. And the UK as well, and I do think attention is now going to turn to the economy more than interest rates, and we are seeing some signs that there really is a recession on the way. The degree of which is still up for debate. A lot of people saying soft landing, a mild recession, but we've seen some horrible figures out from the US, particularly the Empire Manufacturing Survey, which was absolutely horrendous.
Did you see overnight, actually, the other Discovery Financial ones as well, who do sort of like credit cards to lower income families, and that came out with really high delinquencies. So their shares were off heavily, I think, overnight. So that sort of like fits what you just said, actually.
I mean, there's a few signs. We're seeing, slight rise in auto delinquencies over in the US. We had some news which we discussed last week about the housing market. So I mean, the signs are not that great. Jobs market's still strong, and this is where you get the sort of the dichotomy. So with that strong jobs market and wage growth as it is, that the central banks are still, their hand is still tied towards interest rate increases. But we are seeing we had some news from the recruiters, Page Group and Robert Walters, in the last week or so, and they were pointing to very uncertain times ahead. So I think as I say, recession is where and the economy is where people will start to look now, because it will impact companies.
Yeah, no doubt about it, and it probably impact margins. Actually, I think it's probably one of the weak link, the sort of the Achilles heel, isn't it, of the corporate world, because profit margins have been going up for the last 20 years, and just by mean reversion they come down. Now, I guess there's sort of the next $64 million question then, John, is what you've been doing with your portfolio. You've been sort of like heavily going into cash, or how have you sort of positioned it on a sort of asset allocation basis?
Well, I'm still largely in cash. I mean, I got lucky with my timing, as I've mentioned before. So, I transferred a lot of corporate pension money into a private SIP. And just as I did that, markets sort of towards the end of 21, markets started to roll over. And so I didn't deploy a great deal, and a lot of it. And so it's largely where it is. I did buy what I thought was a value stock, which was BT, which has not proved such a value stock at all. It's proved a falling knife, a value trap even. I bought Unilever.
Oh, okay.
And that's done really well. And I think that sort of speaks to this idea around buying companies with pricing power, because Unilever, with the strength of its portfolio, the brands that it has, really does have the ability to push prices up and hold its margins. Alluding to what you said about margins earlier. I bought Somero early on.
Somero
I bought out a while back, and I haven't done anything with it. That's had a really good month.
What does Somero do?
Somero Enterprises. It's basically, they make machines for leveling concrete streets.
Oh, see, Somero. Okay,
yeah.
Yes, gotcha.
And it's a growth company, but looks very cheap.
Yes.
And even before the sort of massive derating of growth shares we saw across the last year, it was looking cheap. The worry there is that if there is a big recession, it is a cyclical company and it's exposed to weakening in construction markets. My thesis would be that companies like that, even if there is a weakening sort of residential construction, some of the sort of office type real estate, commercial real estate, it should actually start to do well if there is a shift towards infrastructure spending, which I think there's going to be as a result of the economic weakness that we're seeing. I think infrastructure investments, pushed by governments, are really going to step in to sort of fill the void in the economy.
Yeah, I think Somero also do the levelling for a lot of the big sheds for the onlines, which has had a great time. It might have a slight air pocket while things catch up, I guess, which is probably what's giving it more value, I suppose, in the share price. I must admit, I've had a couple of sort of like one up, one down in my portfolio. When EQLS came out with some fabulous trading updates, they do sort of forex, sort of foreign currency services, international payments, and they're taking market share from the banks. And anyway, their shares, their revenue was up 60% like for like, and sequentially second half, first half up by 22%, increasing margins. So they're getting the operating leverage. So that was been a good one. But on the other side of the coin, I've been one of those with Boohoo. So I've been crying all to the bank on that one. I bought it about £2.60, and I think it's bumping around sort of 45p. So I got that one big wrong. But
I'm not a big fan of the sort of fast fashion retailers, particularly the online ones. They had a massive tailwind, from the pandemic and lockdowns, and they had a tail. It was just a growth story. But the thing that really drove it, as far as I could see, was cheap manufacturing, but also free returns.
Yes,
and actually, the economics of that industry, to me, just never stacked up. And so, along with sort of Boohoo's corporate governance issues, which was a real problem over the last couple of years, I don't like it. I'm not a big fan of very cyclical retail shares.
Yeah, well, you made the right decision there, because it's lost me a shed load of money. What's quite interesting, actually, their trading update this week, they seem to have solidified their actual trading in terms of, yes, the sales on a like-for-like basis year on year have gone down, but they're still 35% up when they were pre-pandemic. And their sort of real problem areas have been the freight incoming costs, and also the actual shipping out to the States, which has taken a lot. Effectively they can't compete with a 10-day sort of lead time in fast fashion, and so they're putting RDCs out there. But I have noticed, actually, just on this is something to have a look for with other people who, just any broad issue for investors, the short interest on Boohoo, and you were probably one of them, I guess. But anyway, probably not. That's actually decreased. It was 10.4% in September, and is now down. I'm still heavy. It's down, but it's down to 4.6%. So I think people are getting a bit more comfortable. But I'm with you. I think it's high risk. It isn't one of my sort of like better plays. But you've got to, if the business can actually come out of this in 2 or 3 years' time, it'll be a lot fitter and a lot more resilient than it was. Now, I need to sort of pick your brains on the insurers, actually, or just one of them. Direct Line, and it basically came out with a trading update, I think 2 weeks ago, and it's an income stock. It got absolutely battered, and largely because of things outside of its control, because of the cold weather. There's a lot of domestic burst pipes and problems in terms of sort of like damage to houses and properties and stuff like that. So its claims ratio has gone up, and then it's had a bit of a perfect storm as well in terms of the sort of the car insurance, because they've had car inflation, and lots of people have sort of been putting in claims for those, which again is higher than their expectations, and also in the summer they had subsidence with houses because it was so warm. Now what's that meant is it was traditionally been an excellent income stock, and I think the shares are trading at about £1.75. And just to give you an indication of the income, since it listed 10 years ago, it's given shareholders £2.70 in dividends, so nearly £1 higher than the existing shares in straight dividends. So it's a big income stock. But the sort of like what's good in insurers and an inflationary world is, with interest rates going up, then the premiums they get will generate more income for them for their investments. Plus, if it's an industry-wide issue, and there's obviously brands and stuff like that, and they have Direct Line, they have Churchill and Green Flag in these sort of areas, then effectively, those key players in that industry should be able to move prices up accordingly, because obviously you get more claims, then the premiums go up. And it's trading at a sort of like it's sort of 7 or 8 times PE. I'll put it up on the actual comments, but just really just top level. Is this a value trap, or is this a sort of like a value player? I don't want it to be like a BT, but
yeah, I mean, I don't really like insurance. It's never been a sector that's appealed massively to me. Yeah. Mainly because, as you say, it's often driven by factors outside their control. I mean, I've seen a lot of cars in ditches around Suffolk over the winter. Honestly, it's extraordinary. But the other factor outside their control, as you allude to, is the sort of interest rate environment and their ability to earn on their investment book. Yeah. And it's just been really difficult for them for years. Yeah, it might change, but I'd like to wait and see. In that sector. And also it's massively competitive. Price comparison has allowed a lot of shopping around to get the best deal. And there's obviously regulation now coming in that means that new renewals have to be offered at the same price they're offering to new customers. Yeah. And their ability to kind of make money in the way that they used to, I think it's been curtailed.
Okay, right. Well, I'll stick it on my watch list anyway. Is there any other companies you've been watching at all, or in the last sort of a news flow? There's plenty on obviously in the healthcare side, which I'll just touch on in a moment.
Well, we spoke about healthcare the other week, and one company that I have had a dabble. And I say dabble, I've not gone in big. Is hVIVO. Yeah. I really liked it. Spoke to the chief exec. It's profitable, certainly on the cusp of significant profitability. Does clinical research support essentially in infectious diseases. It's a big area. The pandemic may have had few silver linings, but one of them is that healthcare spending is on the up for investors. This is a good thing. And infectious diseases are a key focus of vaccines, obviously. So I think it's just in the right place. It's winning big contracts. It's selling more to its existing customers. It's just got all the right ingredients.
What sort of multiple is it trading on?
I mean, I don't think it looks cheap on a headline figure because so it's really on the cusp of profitability.
Oh, okay.
However, it's 28, 29. So yeah, not cheap at a headline level. That's a forecast PE. But I do think the growth is there to support that rating. The other one I was really tempted to have a go at is actually a spin out from that company was Poolbeg.
Oh, okay.
Yeah, I mean it's more actually on the drug discovery side of things, treatment discovery. Uses AI to support its approach. I just really like looking at it. The shares up about 50% over the month. So I bottled it and missed out. But I do like it. I'm just always worried about those sort of small biotechs and the hit rate on new drugs. There's every chance that a new drug doesn't make it to market. I think it's a 5% chance of success. I think from speaking to them, from looking around, they've got an approach that improves their chances. But nevertheless, I do think drug research is tricky. It's tricky.
Oh yeah, and there's no doubt about it. You've got to sort of play the odds, I suppose, to a certain extent. And there was one company actually that I'd been watching a great deal, came out with really unbelievably scientifically terrific data this week, was Avacta, and they on Tuesday they basically said that their phase 1A trial data for their new prodoxorubicin sort of chemo warhead, sort of targeted chemo warhead drug, it not only met its sort of its main sort of target, main goal, but actually reading between the lines, I think it surpassed it. And just give it an illustration to sort of like investors about what this particular drug does. I mean, there was a guy actually I go swimming with, and he's 70. He's in a bad way. He's just been diagnosed with stage 4 lung cancer. Now, prodoxorubicin probably wouldn't do lung cancer, but it's a hard tumor, and so his only option is to do chemotherapy, and effectively limiting the amount of chemotherapy you can do because of the side effects. It sort of impacts your kidneys and your heart and all kinds of different conditions. Now, with this, sort of like the precision platform they have, this chemo uses an enzyme that basically deposits the chemo onto a particular tumor. So what that means, and this is what the results have come through, is that the safety data for the Prodoxorubicin, it doesn't basically allow any of the chemotherapy to go into good cells around the body, but just deposits that chemo warhead onto the hard tumor. So what you get there potentially, if this one eventually comes through to market, which would be a huge boost for cancer patients in particular, is that you'll be able to have a much higher dose of chemotherapy, which is proven over 30 years to be very effective, but you won't get the side effects of it. And that means that, the guys like this, they've actually got a chance of beating this disease, because, or at least extending their life, because it will shrink the tumors without causing the sort of the side effects, which was what effectively limits the amount of chemotherapy anybody can take, you see. So it was fabulous. I mean, the shares were up 20%, but that really sort of like, when you come back to sort of how do you reduce your odds of non-success at all, having a drug that you already know and understand out of 30 years is probably a good way of doing that. So.
Yeah, absolutely. Precision medicine essentially is what that is. And,
yes.
I think the advances, in healthcare, and a lot of those advances being driven by, increasing computing power and sort of, the integration with the technology industry. That's what we should be looking at.
Yeah, absolutely. I mean, and it was funny actually, because I interviewed the CEO, Alistair Smith, for the first time 2 years ago, and he's got so many different sort of like potential shots on goals with the technology he has, with the PRISM technology and the AFAMA sort of like technology it has. But he said his personal number one objective was to bring this particular drug to market, because it will be so beneficial effectively to mankind, not just in developed markets, but across the world, because chemotherapy is obviously is off patent, and so it'll be a lot cheaper. But anyway, I wish them all the best. But I think I'll just highlight it. It's terrific. I mean, it's a terrific opportunity. This is a total addressable market of roughly around, people, $50 billion. I mean, it's enormous.
Yeah, I mean, the thing I also want to see in that certainly pre-revenue drugs companies is a decent balance sheet. So they've got to have the cash there to take these programs, through to that stage, or at least the stage where they can find a partner.
Yeah.
So, having the money in the bank is definitely the thing to account for. The other company in healthcare that I like, it's not medicine per se, it's more in the medical devices side of things.
Okay.
Is Intelligent Ultrasound.
Oh, okay.
Yeah, it's a nice company. I've spoken to them quite a few times now. It's basically, again, it's AI based, and I think there may be emerging here, which is the integration of AI into lots of things. It's I think it's really coming of age. But they're using AI in ultrasound to basically augment the skills of ultrasound practitioners. They're using it in training. They've got a big partnership with GE Healthcare that makes, it's the basic world leader in ultrasound machines for sort of fetal medicine.
So that must be a huge rubber stamp of this quality of the technology, because GE isn't going to go partner with a small, a relatively small company on AIM unless the technology is top notch.
No, absolutely not. And it works. And I think they had a tough pandemic, because this is the kind of stuff that depends upon people getting into hospitals. They, a lot of these companies, particularly in the device side of things, sell through by going into hospitals or by going to trade fairs. All of that stuff got shut down. So there is a sort of recovery track there as business returns to normal. But in terms of the technology, it's there. It's good. The question is, at what point does that hit revenues? So the GE, the AI enabled technology is a relatively small part of business, and I guess what we want to see is sort of some kind of sales momentum there. They're setting up direct sales teams in the US. Appears to be working, so it's on the watch list. And I don't mind missing the bottom. I'd like to see something on that sort of upward momentum. Happy to lose a few percent at the beginning, but yeah, I really do, as I say, like look at this company. it can extend its technology into other areas. Oncology being another one. I think it's moving into sort of the liver scanning at the moment, which is potentially good news, given everyone stupid during lockdown.
No, and the advantage with the ultrasound is because it is effectively sound, sort of like waves. Then it's a lot safer, isn't it, than X-rays? You don't get that problem. And the resolution of these pictures is becoming far better than they've ever been, aren't they?
Yeah, well, what this is doing, it's enabling practitioners to look in the right place. They use it for anaesthesia as well. So they're going to think of needle trainer. So it's basically basically helping practitioners know how to anaesthetists to train them to actually deliver anaesthetic in the right place. And all of this stuff bodes well. They call it classroom to clinic. So training people how to use it, and then it gets out them in the field. And those things you would hope at some point really sort of coalesce into a really virtuous circle. I'm not sure we're quite there yet, but it's definitely on the right track to raise some money. So it's potentially all uphill from here.
Yeah, no, I mean, I'm with you. I think if you go, particularly in the medical devices, go best in class technology, you usually find you can sort out the sort of funding, but it's getting those partners in place and getting your distribution. I mean, another one exactly which fits the bill is Belluscura, and it came up with a trading update that is effectively commercializing its patented and FDA approved portable oxygen concentrators. And they've got a really big year ahead of them in 2023. And Dowgate are putting out sort of like they're looking to sell 12,000 of these, which frankly, they should be able to do as long as they've got the production for it. And the big Chinese manufacturer is coming on stream in Q1. And as we all know, the problem currently with COVID in China, that they desperately need portable oxygen concentrators, essentially like our ventilation machines, but you can treat these guys at home rather than actually in hospital. So that's coming on stream shortly. And if they can bring that as fast as possible, that's just like help so many hundreds of thousands of people. And then likewise, the portable oxygen concentrators in developed worlds where people are vaccinated help the COPD and sort of other sort of respiratory conditions. And there's literally millions and millions of people, in fact tens and hundreds of millions of people with lung, as we talked about, with lung cancer from smoking, that with COPD. So this is a huge untapped market, and their product set is absolutely best in class. They've got a new next generation version coming out, which is lighter and produces more oxygen than anything else on the market. And the key is basically execution now. But I'm with you. I think the principle when it comes to these sort of things is to go into sort of like best in class technology.
Yeah, best in class with the cash. And I think what I'm looking for here is we know that the pandemic showed that there was massive pressure on healthcare systems around the world. It's interesting you mentioned, China and the need to keep people out of hospital. And I think that is something that is true across any healthcare system. So, we should
NHS, for instance.
The NHS is the perfect example. Anything that keeps people out of hospital,
but you can't get in because you're on an ambulance most of the time.
Well, precisely. So anything to alleviate pressure. And actually, there was an interesting little company that had some results this week, Cooth.
Oh, yes, you're right. Mental health, basically software, isn't it? Telemedicine, mental health.
I think that's worth keeping an eye on because,
agreed.
There is, without a shadow of a doubt, mental health crisis, not just in the UK, but around the world. And health systems are not very well equipped to deal with it. So Cooth potentially offers us a solution that sort of bolts onto health services and uses software, as you say, to really help people who are suffering from some of these mental health conditions, whether it's depression or anxiety or whatever it might be. It's a huge problem. It's a huge problem, and
it's mainly for schools, isn't it? It's mainly for schools, actually, in the UK, which is where it came out the heartland. And I think it's got a big contract, hasn't it, in Pennsylvania? Yeah,
I mean, it seems to be picking up contracts pace. And I think it's moving into more adult care as well. So I mean, and it popped onto my radar quite recently, but I like the look of that because, as I say, it's really addressing a growing problem that there aren't really established ways of dealing with.
No, I totally get it, and it's a scalable platform, that one, that you can use that science and the expertise which you pick up and develop over. Literally, they've got from my understanding, they'll have a huge database now from having run with people in the UK that they can lift and shift and utilize that and cut and dice and slice it around the world, particularly obviously in English speaking areas like the US, which could do really, really well. And the gross margins on a software telemedicine business probably are quite nice, I would have thought.
Yeah, I mean, you've got to get to the scale, but as I say, it seems to be growing.
Yeah, no, it's in a good spot. Good spot. Another one which came out is Venture Life, and I know we chatted about it a couple of weeks ago, which does over-the-counter sort of niche healthcare products, and I think it's got a trading update coming out towards the end of January, so I'll be looking forward to hearing about that. But they're as we talked about, innovation has got to be the heart of all sort of healthcare, and they've just come out with their own sort of like licensed out mouth ulcer drugs, which is not drugs, basically creams and stuff like that.
Yeah,
but exactly. But the margins on these things are fabulous, and they'll do all the manufacturing, and they've licensed out to an expert brand who do sort of like mouth ulcer cream. And I suffer from a bit from Crohn's, so I get lots of these things, so it's pretty useful for me. And then they've increased their distribution as well on a number of other products as well. So the key is basically, if you do have high margin products that are in demand and are niche, is to get the distribution out. And if you can't do it in terms of being able to put the marketing support into it, get a third party to be able to do it. And they seem to be doing, seem to be sort of like hitting all that. It's quite a good policy actually, to decide what is your core and what isn't your core, even though you have sort of expertise in areas that you decide not to effectively put your own brand on.
Yeah, absolutely. Yeah. Absolutely.
Another one on the healthcare, we'll just finish on that one, is Avingtrans. Now, this is actually a specialist niche.
Is it healthcare?
Yeah, well, that's it, you see. It's got, obviously its bread and butter is in all things nuclear and defense and big regulated industries, no doubt about it. And it came out with a sort of like a half-year trading update saying basically that, the business is well on track. It's got fantastic revenue for visibility of more than 90% for this year. But then it also said that it's just put some money in, because it's got a really strong balance sheet, had about £17 million of cash and is generating plenty of cash. So this is net cash, which is about 50p a share or something. The first bit it deployed was into its healthcare division, fledgling healthcare, Magnetica, which basically does small form MRI scanners, and it's picked up it's increased its stake from about, I think it was 64% to 71%, or 61 to 74, something like that. But it's increased its stake, and that says to me actually, because they're really quite astute guys, the directors, that they think this has really got a good chance of reaching the market in 2 or 3 years time. So that was good. And then they also bought it was a straight bread and butter bolt-on acquisition of a ventilator, basically a HVAC business, small one in the UK. And the idea of that is it's a regulated market, because building sort of regulations for ventilation and for air conditioning and stuff like that is getting better. It has to get better and better. So they seem to be very much sort of like on track to deliver.
Yeah, I've always liked, companies selling products into tightly regulated markets, particularly on the engineering side.
Yeah.
And if you look back, perhaps quite some way, you had lots of companies like, Halma, Rotork, Spirax, that
yes.
Really, really good British engineers, that really made their living selling into these markets where safety was paramount, where you couldn't cut corners basically, and then there was a time you could pick them up for next to nothing as well.
Yeah,
really high quality companies. They were obviously, their valuations went through the roof, had come back quite a bit. So some of those. So on the engineering side, D-rated engineers, high quality engineers, I definitely think they're worth a look. Avingtrans is not a dissimilar business.
No, absolutely, yeah. I mean, I would class it as a sort of like a super durable long-term grower, actually, because they've got visibility there and margins for years and years.
Yeah, and I mean the other one on the engineering side, electrical engineering, was Judges Scientific.
Oh, okay, yeah, another.
But again, these are all brilliant companies, but their valuations got really, really hot, and they've derated. So I think if you want to go out there and look around, just look at those really high quality engineers and electrical engineers that have come back in terms of their rating. Yeah, I mean there's a bit of cyclicality in there, but at the same time, they're supporting all sorts of industries. So there is a bit of a natural sort of hedge against the downside there in a lot of those things.
Yeah, well, I thought electrical engineers in particular, because all things are EV, then they're going to be pretty much in demand, you'd have thought, as we sort of migrate to a cleaner environment.
Yeah, well, EVs is something I've been looking at this week, actually.
Oh, okay.
So, I mean, Tesla's had an absolute shocker so far this year. I mean, I think it missed some delivery numbers, slashed its prices, all sorts of trouble. And of course, old Elon is causing a lot of trouble over Twitter. And I do think Tesla shareholder are a bit worried that, his focus has gone. But for me, there's no doubt that the shift to, electrification of transport is happening. And the question, I think, is how you play it. And I've spoken to a couple of companies in the last couple of weeks in the lithium mining space.
Oh, right. Okay. Yeah. Now, I understand it. There's about 2 kilograms of lithium in every sort of like Tesla battery, isn't there?
It's massive.
which is enormous.
Yeah, it's the metal, and there is a structural deficit. There's simply not enough supply in the market. There's huge amounts of new mines need to be built to just cope with the sort of projected demand for electric vehicles. And there's a few companies in the UK that seem very well positioned to deal with this. One of which I spoke to last week is Atlantic Lithium, and spoke to the chief executive. No, spoke to the chairman. In fact, the thing I really like about that project, I'm going to put a big caveat on this, by the way. Speculative mining is not my thing.
Yeah. But they've got a big. It's a big sort of like prospective sort of deposit, haven't they? Is it in Ghana? It's in somewhere in Africa, isn't it? I think
Atlantic Lithium is in Ghana. Yeah.
Yeah. Okay. I thought it was. Yeah. No. I mean, I don't know much about it, but that was my understanding. Yeah. And it's sort of coming on stream 24, 25.
24. Yeah. Which is that feels a lot quicker than. A lot of the sort of more speculative miners that we've perhaps heard from over the years, and having spoken to them, a lot of things are in place. A lot of the ingredients are there. The pre-feasibility study looks good. The jurisdiction looks good. They've got the support of the Ghanaian government there. They've got a good partner, and more importantly, the project is pretty much fully funded, if not fully funded. It's interesting. Lithium's interesting. Cleantech Lithium. Ghana is not, by the way, a big lithium producing jurisdiction yet. The biggest.
It used to be cocoa, didn't it? When I was doing my geography lessons.
Yeah, that would be about right. But they want to go up. They want to increase their their GDP. They want to be a value-add economy. So this is the kind of interesting thing they're moving into, and they want to do it in partnership. The governments they don't want to be exploited. They want to benefit from this, and that appears to be what's happening with Atlantic Lithium. ESG, dirty word though it is for some, is really high on a lot of miners' agendas these days. They cannot be the exploitative companies that they once were. They work in partnership with locals. A lot of local expertise will be within those companies. So I think it's really interesting. The other guy I spoke to was the chief exec of Cleantech Lithium.
Yeah,
that's out in Chile. And Chile again, big mining country and massive lithium deposits there, massive. So yeah, that is a little bit further away, but again, a lot of the right ingredients are there. I just think that again, it's just definitely worth keeping an eye on. It's a market in structural deficit, and the demand is going to go through the roof. These are critical minerals.
Yeah, no, I must have had a look at the sort of chart of lithium carbonate, and what's called carbonate. What's quite interesting actually is that it went from it's about 4 or 5 fold compared to it was pre-pandemic, because obviously the transition to electric vehicles, but it hasn't come off like many of the other hard metals like zinc or aluminium or tin or anything like that, which has struggled because of China this has actually retained its value, hugely, hasn't it, lithium?
Yeah. And if anything, the price is going to go higher. So yeah, I think it's a good area of mining to be looking at. And you do worry about sort of hype cycles, and we've seen it before where there's a lot of excitement around a particular metal, and the price goes through the roof, then it comes back down again. But I think there's something more substantial behind the lithium price and the supply and demand fundamentals of that market.
And with the just moving now to sort of like the earnings coming up, etc., just for sort of like, they've started obviously in the US, but in terms of England and Europe, etc., that'll be over the next month. So what sort of sectors would be sort of good sort of bellwethers? Well, let's start. What about the banks, etc., because they give you a good sort of view of what the economy is doing, don't they? And then perhaps dovetail that with another sector you quite like, which is the sort of like the H&T and the Begbies, the insolvency boys.
Yeah. I mean, we've already seen some numbers from the banks over in the US.
Yes, exactly. Yeah, and they were a bit mixed. They were mixed, weren't they? I think it's probably a polite way of putting it.
Yeah, I mean, Goldman missed.
Yes,
I think it was Morgan Stanley hit its numbers, but profits were 50% of what they were a year before. If we see, I mean, all of the UK banks, because I guess that's what our listeners will be more likely to be invested in. They all do slightly different things. They're all exposed to slightly different areas of the market, but if you look at the sort of major lenders, the domestic lenders, Lloyd's,
they've rallied a lot now. They're not far from book value, which is surprising because I think they started sort of 3 months ago at 40p, and now they're sort of like 50p as I last saw, or 49. So they're not far from. There's quite a lot of optimism now suddenly built in.
I mean, I guess this is a real classic case of that inflationary cycle versus the recession cycle. So obviously an important way that banks earn money is that sort of net interest margin.
Yes.
And in a low interest, or ZIRP world, low interest rate world, it's hard for them to make money. So an inflationary environment where the response is from central banks is to raise interest rates, on paper, that makes it easier for them to make money from their loan book. The flip side is that it also means that markets like real estate, which they lend to heavily, it's a very American word. I mean commercial real estate.
Yeah, commercial property.
The housing market, activity potentially softens quite significantly, and we're already seeing that. So
loan growth goes negative.
Just goes through the floor, and so basically you've got this balancing act between we can make more money on our loan book, but the loan book is potentially shrinking because people don't want to take out, or banks just won't lend. They're not comfortable lending. So if those shares are, as you say, trading close to book value, then where's the value in the sector?
Yeah. What about those insolvency boys? I know you quite like the sort of the other side of the coin. If you've got a darker view about the recession, then the likes of Begbies are going to have a roaring trade.
Yeah, it's a funny one, Begbies, because the shares never seem to do a great deal. They're up 10% over the year. And you think, well, recession is on the way. And we see certainly lots of signs that corporate insolvencies are on the rise. Begbies themselves published this thing called Red Flag Report. And it's increasingly gloomy. Business failures or the signs that there may be a wave of business failures on the way are rising. But they never seem to really move on the back of this news. So I like it, but I keep looking at it thinking, well, come on, it's got to happen soon. But as I say, it just doesn't seem to happen. But maybe it will. The other one is H&T. Obviously, it's slightly different. H&T,
pawnbroker, isn't it?
For all intents and purposes, a pawnbroker.
Yeah.
And their numbers recently were, again, people using their services is on the rise. The other thing they're exposed to is the gold price, because obviously a lot of what gets cashed in is gold. Gold's been also, surprisingly subdued. It's sort of been down and then up, and
Well, I think it tends to inverse relationship with treasury bonds. Yeah, well, treasury yields, isn't it? Because it gives you no carry, and therefore, if the interest rate on you can get under just buying a treasury at 4%, then the gold price has little attraction. It will come down.
Precisely, but if you're expecting some sort of economic Armageddon,
okay,
then there is the idea that gold is a safe haven or an inflation hedge. But you're right, a weakening dollar, and by dint of that treasuries, is good for the gold price. And we are expecting to see now, having seen that dollar strength at the end of last year, there is most people are suggesting or forecasting a quite significant reversal. And so that's potentially good for the gold price, and that's potentially good for someone like AVCT, who's seeing more people coming through the doors, and what they have in their pledge book increase in value because it's gold.
Yeah, I'd agree. It should be a good counter-cyclical play, isn't it, really? You can sort of cover bases. Actually, what's also picking up now, and it's been a bit quiet, is a sort of the M&A activity, because certainly before Christmas, one of my stocks, Crestchick, has got sort of like bought out, or has been at a bid, which will be voted on the 5th, I think, of February.
Yeah. Interesting one, that. No bidding war.
Yeah. Not yet. Anyway, we'll wait and see. I mean, to be perfectly honest, as a shareholder, I'm frankly delighted, and the management team have done a fabulous job of turning this business around over the last 3 years. So I totally tip my hat to them. But it's just quite interesting. There's a couple of hedge funds there who have been picking up shares at around about £4. So they think there is a chance there's going to be, and I don't want a remote chance of somebody putting another bid on it, because these guys don't go around just trying to make 1 pence out of £4 because the transaction costs don't work. But
I did hear complaints. There were a couple of takeovers or certainly offers at the same time. K3 Capital.
Oh yes, okay, yeah. Justin did well out of that, I think.
He did, yeah. Was one that popped out one of our stock screens. And again, it's sort of in the, if I'm right, in the sort of insolvency,
legal services,
legal services type space. So it's kind of well positioned. But there were complaints that companies were letting themselves go too cheaply.
Well, Serafine this morning was trading at about 9p, 10p, and then got a bid just this morning for all cash at 30. Admittedly, it's a lot less than it was sort of its IPO at £2, but even so, it just shows you that actually there is people are picking sort of assets off the market quite quickly, aren't they?
Yeah. There was another one I noticed got bid for. Again, it was something that popped out of our stock screens, but it's a company I've liked to look at for some time. That was Devro.
Oh, okay, yeah, the sausage guys, aren't they?
Sausage skins.
Yeah, that's it. Yeah,
exciting world of collagen casings.
That's right. Yeah,
but yeah, they got a bid. 50% premium, and that's what you want to see. That sort of premium is what you want to see, because the UK market, particularly at the smaller end, has derated quite significantly. There is every risk that this is a happy hunting ground for overseas predators.
Yeah,
I think there was a report this week. Jamie Constable from Singer and I spoke about it. But the UK's attractiveness as an investment destination has gone through the roof. I think PwC conducted a report. It's now the third most attractive global investment destination. You wouldn't think that, given if you live here. but
it's so cheap. The value is just there, isn't it? You just got to look at the headline. The FTSE 100 was flat last year, but the small caps AIM was down 30%. So that level of 30% underperformance is just totally off the charts. Is totally extreme. And I think the small cap index trades at roughly around about 10 or 11 times forward, earnings. If you strip out the loss, the real sort of like the loss-making ones, and just look at the ones that are profitable. So it's real value there, no doubt about it.
Oh yeah. It's been a horrendous derating. It's something I discussed this morning actually with Scott Evans, who of London Business School, who compiles the numerous smaller companies index. And there has been a horrific derating, particularly at the small cap end this year. And particularly some of the sort of higher growth companies that were more exposed to kind of rising interest rates. Obviously, we know the mechanism, the value of future cash flows decreases, blah blah blah. There's a lot of rich pickings out there, and what Scott concludes, and it's the videos up on Vox, is that actually the number of what they call fallen angels, companies that have fallen into the lower value index, is at one of the highest levels it's ever been. and when we've seen periods where this has happened before, and I think he points to 1975, which followed a horrific bear market, 73, 74, and 2009, which obviously followed the credit crunch. They were the years in which small caps went absolutely gangbusters. And so the big question is this that year? And as you say, looking at those, that massive derating and the potential for overseas bidders, or just anyone looking for value. And actually, the question then is, well, actually, a lot of growth stocks are in value territory now as well.
Yeah, Tesla.
Yeah, or big tech, big US tech.
Yeah. Facebook.
We could see some real outperformance next year, but M&A might be part of what's behind it.
Yeah, no, I'm just finishing on that one. I mean, I had another one in my portfolio which got a bid which was quite attractive, which was Pharma, which we used to be on AIM, but has actually moved out to NASDAQ and was trading at about $7 per share. Got a bid for $14.50 off a Italian pharmaceutical company. So again, it just shows you, if you go to best-in-class technologies with good sound balance sheets, good management teams, and defensible sort of products and services, then if they're trading cheap, you can almost guarantee somebody's going to have a good look at it, because it's an easy one for the acquirer's board to approve, because you get a guaranteed earning stream, plus what the synergies you're going to get because you've worked that out on the cost side, what price, and therefore it's a lower risk deal rather than buying something where you got to turn it around. Yeah,
I agree, and I think the UK is not well known for tech. We don't have the wealth of tech that they do over in the US, but what we do have, appears to be really good quality. So
yeah.
I had a good chat this morning with John Prideaux's the chief executive of Boku, which is the the mobile billing company.
Yeah, they're really sort of shooting a blaze, aren't they? In terms of, I think it's out in Asia, isn't it? They do a lot
big part of business is out in Asia. They're sort of shifting the model to so it was direct carrier billing, so you basically build your e-commerce purchase through your mobile bill. They're moving to local payment gateways. So it's a business in transition, but what they expect to see at the end of it, is a much more valuable proposition. They've just signed a massive deal with Amazon.
Have they?
Massive deal with Amazon. Hasn't even kicked off yet, not even in the numbers. So that's expected to kick off soon. Expect some news flow this year. But in terms of quality tech, that would fall into that bracket. There's another company I've been keeping my eye on, but only because I use it. And I hadn't realised it was listed, but it's a company called Auction Technology Group.
Oh yes, I know. Yeah.
Yeah, it wasn't. It's not really very high profile. It's very, very strange. But I'm in auction land out here in Suffolk, so
okay.
So I've been enjoying the online auctions. It took me a while to sort of put two and two together, and this is the company powering it. It's fantastic technology. You think about an auction where you've got room bidders and web bidders. That thing cannot go wrong. It has to be super real time. There can't be any latency, any delay in it. That technology is fantastic, and what they've got is a group of sites that gives them presence in the UK, Europe, the US, art and antiques, commercial. It's a really, really interesting company. And I'm just looking at the valuation. So for a tech company,
not, if I remember, I had a look at it, and it's not cheap, but it's the highest quality recurring revenue stream type business, isn't it? Because it's a platform that generates super normal sort of like operational gearing.
Yeah, exactly. So it's I think 24 times earnings looking here. So no, I really like it. And I think again they're at that point, that inflection point where this potentially really starts the numbers.
It's
really
not a small business though, is it? It's not a bit. It's pretty big already.
No, getting towards $1 billion.
Yeah,
and still growing fast. And it's the kind of stuff that does well in a recession as well. People start putting a lot of stuff through auctions, second-hand goods rather than new. So yeah, I've got my eye on that. I do like it. And then in the UK, I think we've got a fantastic fintech sector. Absolutely fantastic.
Yeah.
We've got companies like Fintel, TrueFin, Augmented FinTech on the sort of investment company side. We're world leaders in fintech over here. So
yeah, I think Argentex is another one which is basically it's got a trading update coming out the next couple of weeks, so that'll be quite interesting to watch out for.
Yeah, definitely fintech should be on everyone's watch list.
All right, Brill. Well, thanks very much for your time, John, and look forward in chatting again in the near future.
Absolutely, all good fun.